Everyone talks about being the bridge between TradFi and DeFi and crypto. We've actually done it at GenTwo in the sense that we are able to create securitized vehicles which make it easier for institutions to get into the space. When financial institutions want to get into the digital asset space, there are 3 C's that we have to go through: compliance, complexity, and custody. These SPVs are done to move things completely off balance sheet and be bankruptcy remote. If something happens to the main entity, nothing happens to the assets in custody, and that's an important part of it.
This is the Assetizer Podcast.
Hello, everybody, and welcome. My name is Tom Lyons. This is the Assetizer Podcast, and we are here today in the boardroom of GenTwo to talk with my good friend Mark Arasaratnam, who has recently joined us and taken over as the lead for GenTwo Digital. We're going to be talking about GenTwo Digital, we're going to be talking about the crypto markets, we're going to be talking about bridging TradFi and DeFi and all sorts of fun stuff. And it's really nice to be, for me to be talking blockchain again and talking crypto again. Awesome. Because since I came to GenTwo, which has been great, I kind of got a bit out of the blockchain world I used to be fully into. So it's nice to take a little trip back. Yeah. And Mark, welcome to the show.
Thank you for having me. It's kind of cool to be here.
Oh, I'm glad. We're glad to have you.
Setup, huh?
Yeah, it's not bad. We're a DIY shop on the podcast front, and I think that's the way it is these days.
It works.
And it works, yeah. All right. So as usual with these things, why don't we start off with you telling us a little bit about yourself, your background, and how you ended up here.
Okay, I am Canadian by way of the UK. I came to Zurich about 6-7 months ago when I joined GenTwo. I'm managing director of GenTwo Digital, which is the digital assets arm of GenTwo, the mothership. My background is quite varied. I started my career as a high-frequency equity trader, then went into FX, global macro, fund of funds, did a bunch of entrepreneurial things. I was global head of strategy for an ad tech company, a CPO for a fashion tech company, as you can clearly see.
Absolutely, yeah.
And then I was co-head of digital assets for a company called Merix, which is a very large brokerage business, a global business. So I ran the crypto desk where we created structured products linked to crypto. And now I'm in sunny Zurich.
Great. I know over the years this has become a cliche question, but I'm going to ask it anyway because it's my show.
It's your show.
What's your rabbit hole story? How'd you get into crypto and blockchain?
Through friends. It was always done through friends in the TradFi space.
Bad influences.
Bad influences. Anyone who's in investment banking, M&A, or in trading, all are constantly looking for yield, find new ways to make alpha. And so I got in through some bad friends who brought me into the rabbit hole, and I've kind of never looked back.
When was this?
2017, 2018.
Yeah, about the same time I got started. Okay. And you're here at GenTwo Digital now, running the show. Why don't you tell us a bit about what GenTwo Digital is, its mission, and what you're trying to accomplish?
Sure. Everyone talks about being the bridge between TradFi and DeFi and crypto. The bridge, the path, the stream, whatever you want to call it. We've actually done it at GenTwo in the sense that we're able to create securitized vehicles which make it easier for institutions to get into the space. The history of blockchain it's been fraught with UX, right? There have been UX issues since day one. Even now, people need to go through wallets, which are difficult to use for the most part. Private banking institutions, high net worth individuals want to get into the space, and they've not been able to do so until now. The ETFs made a big difference in the space because they created essentially a wrapper that allowed investors to get into. It made it easier. It lowered the barrier of entry for them. Even so, there are still aspects of crypto which make it difficult to get into the space, and that's where we come in. We've been, as GenTwo, as a company, we've been securitizing assets, all kinds of assets for the last 7 or 8 years, from buildings to art funds to wine to, you name it, any esoteric asset class, fund derivatives, private equity funds, trackers, hedge funds, all that kind of fun stuff. And so this is kind of bread and butter for what we do. We've already created the legal structures for the stuff, and we've created the actual financial engineering background for all this stuff. So digital assets was kind of an easy thing to sort of bolt onto because we've already had the experience to do this. And so we kind of bolted it onto the main offering, and it now makes sense. And so we're getting a lot of traction as well as insight as well as demand for the stuff that we want to be offering from institutions because we're a B2B to B, I guess.
Right. Or sometimes we call ourselves B2B2C.
B2B2C or
Depending,
whatever,
whatever, okay.
whatever acronym you want to use.
All right, so actually, while we're on that subject, who are you catering to? So if I understand correctly, we're looking at, on the larger, bigger picture, we're looking at people who want to invest in crypto, but also we're looking at crypto projects or people with tokens
Yep.
who want to bring them to market outside of
That's
the
absolutely
crypto
right.
world, right?
That's absolutely right. So when we talk about liquidity in crypto, there is the large liquidity is still in traditional financial rails. We
By
don't
far.
have- yeah,
By-
by leaps and bounds,
by,
orders of
by
magnitude,
orders of magnitude,
higher,
right.
much higher than you can see in crypto. And so what crypto native companies are doing is they're trying to figure out how they get TradFi to come in a regulatory compliant manner. And they have to do it this way because that's the only way they can get into the space, because they're heavily regulated institutions, right? And so that's kind of what we're seeing at the moment. We're seeing their demand from external asset managers, from hedge funds, from broker dealers in the space, to tokenization engines as well. And the next step is tokenizing, not only equity but private credit, private debt, because we moved on from cash, which is USDT, USDC, to money market funds, to private credit. So we can see that we're going through the yield, right? So we're going from zero yield, from pure cash, to money market funds, to some yield, to now private credit. And so we're going up the risk spectrum. So we're seeing that kind of demand because we could be the financial engineering platform for behind all those kinds of projects.
And in terms of going up the curve, we can also do that in terms of complexity, right? Because we can also
Sure.
structure products.
Yeah, that's the beauty of what we do as a business. I mean, yes, we call it AMCs, trackers, CLNs, and by the end of the day, we are wrappers, right? So we can wrap any kind of asset into a security. And digital assets, given that custody now is becoming a lot easier because regulated players are getting into the space, like Zodia, for example, or Kaiser Bank here in Zurich. They're all regulated players who can do it properly in a regulated fashion. And as custody becomes the de facto and become very easy to work with, then it becomes easier to store tokens,
Okay.
custodized tokens, I would say.
Let's get back to the structured products afterwards.
Sure.
Maybe to start off a bit more along the value chain. So let's say I'm going to come to you and I would be a typical client, perhaps an asset manager who wants to issue a crypto product, right?
Right.
And I know there's ETFs out there, but I'm going to do something a bit more tailor-made to my clientele. Maybe I have a family office or something like this that has a specific needs. I want to do some sort of mix, a basket.
Sure.
And I want to throw some structures on it. How's it going to work? I come to you. What are you going to tell me? What are we going to do?
Okay, so it's fairly easy to onboard a client for us. If someone wants to create baskets, I mean, they can look, if they want to get into crypto, if they want to buy BTC, they can buy spot or they can buy the ETF. That's a no-brainer, right? You can do that right
That's easy
away.
enough, yeah.
You don't need us to do that. I'm saying go to your brokerage account and buy, Bitcoin ETF very easily. If you want to do something a bit more complex, when you want to do baskets of tokens or you want to do yield stuff, like maybe potentially look at staking as well. So you can stake any proof of stake token, like just ETH or Cardano or Solana. Then we can wrap those into a tradable security. And we do that by creating a segregated vehicle, an SPV. And then we essentially wrap that into a security by slapping on an ICE into it. And we have that Swiss ICE in it. And we manage all the lifecycle events behind that vehicle as well. That's basically what we do.
So I would
automated that.
I would onboard and I'd get my own SPV. Is this correct?
That's correct.
And then I'm off to the races, right?
You're off to the races, yeah. So as long as we're able to custody those assets in a way that's meaningful and compliant, then you can do it.
So I can use the platform to create
Absolutely.
whatever product I want.
Yeah. So your job is to be product focused as much as we can, as much as you can, and our job is to enable you to be product focused.
Okay. There are several parts of our setup that I definitely want to touch on. One is this off-balance sheet aspect of it, which I think is very important, especially for larger players who may have balance sheet issues if they want to issue crypto products, right?
Yep.
Crypto-linked products.
Yep. That's a big deal, right? So what's happening in the world? I mean, forget the U.S. for now, because they're going to move. I mean, the velocity and ferocity by which Trump is making decisions in the U.S. is actually very good for crypto in the U.S. When it comes to the rest of the world, the regulators are moving, but at a much slower pace. And in Europe, we have Basel III requirements and prudential requirements, and this makes it very difficult for regulated financial institutions to have crypto on their balance sheet, because you have, 800, 1200% RWA requirements.
Right.
And these are important. These make it almost impossible to deal in crypto. And that's why these off-balance sheet structures make a lot of sense. And they're truly off-balance sheet, right? You have independent directors, you have a trustee based in Liechtenstein. These SPVs are done to move things completely off-balance sheet and be bankruptcy remote. If something happens to the main entity, nothing happens to the assets in custody. And that's an important part of it.
Which I imagine is also nice for me as the end investor.
Yes.
Buying one of these certificates or investing in one of these products, because I know that it's, in essence, more or less asset backed.
Correct. Fully collateralized.
Fully collateralized. So certainly all of this is happening and against the backdrop of what has been a real maturing of the crypto industry and
Yes.
a real mainstreaming. And I've been waiting for mainstreaming for
We've
since
been
I got
talking
involved
about it
in
for
2016. And it's been step by step by step.
Yeah.
But this really seems to be an inflection point that we can believe in. And in terms of the overall infrastructure of the crypto world, what are you seeing that's interesting for you?
The exchanges are becoming a lot more legitimized, and they're actually sort of going more vertical as well. And what I mean by that is, say, look what's happening with OKX. They're getting MiFID licenses, they're buying MiCA licenses. This is happening across the board for a lot of the largest liquidity players in the market. And that's a good thing. It makes it easier for them to work with regulated financial institutions on this side. So they can run the gamut from staking to spot liquidity to derivatives as well. And so this is kind of what's happening in a burgeoning asset class. It's becoming a lot more legitimate now. It's hard to ignore. Now it's impossible to ignore.
Right, and that's of course going to,
It's going to manifest itself in all kinds of fund strategies that people want to look at.
and therefore more adoption and
lot
more
more,
mainstreaming and people get
exactly.
more comfortable,
Exactly.
et cetera, like that. Okay.
Yeah.
So you took the stage last week at the Acid Rush event that also is put on by GenTwo. And among other things, you talked about the 3 Cs. You want to tell us what they are?
Sure. When financial institutions want to get into the digital asset space, there are 3 Cs that we have to go through. And that's what you alluded to, is compliance, complexity, and custody.
Mm-hmm.
Compliance is a bit nebulous because right now the world is still trying to figure out where it fits into the digital asset space. And governments are trying to figure out, okay, how do we navigate? That gets complex, right? So people are hiring whole teams of lawyers to figure this out. The other part is complexity. So from an operational perspective, from a settlement perspective, blockchains are fundamentally different to the way traditional assets settle, right? Traditionally, you have cash, you have equity, you have fixed income, you have FX on different rails. And for the first time, you have cash, equity, fixed income, everything on the same rails. And so it's fundamentally different by design. And that makes it complex because we're not used to settling those kinds of securities previously, because we spent the last 100 years working on regular asset classes. And the last one is going to be custody. Custody has been difficult in the early years of crypto, and now institutions are becoming a lot more, savvy in terms of who they want to be interacting with. It's also now become a very low margin business because at the end of the day, regulation will drive the way custody solutions are built from a technology perspective and from a compliance perspective. So we'll see margins come down. It'll make it cheaper for people to custody digital assets over and above just self-custody. And that's why you have bigger players like, real banks that are getting into the space from like Zodia, for example, run by Standard Chartered.
So now that we've got the infrastructure part sort of settled, it's really getting institutionalized and
Sure.
and like we've said, getting mainstreamed. Let's talk about use cases.
Yeah.
So what do you see are the interesting use cases for somebody who might come to us that we can do that maybe others couldn't do and that you might want to take advantage of? And maybe after that you can talk about a couple of the products or clients.
So first and foremost, people want to get access to this asset class in a regulatory compliant way. And that's done through structures that we create. Right, so AMC, the CLNs, the trackers, that sort of stuff that we kind of know and been doing for years, that's very easy to create. The next step is people want to look at tokenization. When you're creating a tokenized product, we don't have native issuance on chain just yet. I think we will get there at some point, but right now we're still working through our existing compliance structures. And for that, you need to segregate your assets into a vehicle, and then you can tokenize the vehicle itself. Right, it's called tokenizing an SPV.
Mm-hmm.
With GenTwo, we can we create the certificate, And then we can work with the tokenization engine to actually tokenize the product. So you can have tokenized Tesla shares or Google shares, for example, or a basket of Tesla and Google. And that makes it super interesting because right now then you can have, 24/7 settlement and you have T+0 settlement as well. And that's when you move from, everything existing on different ledgers to existing on one particular ledger. And it drives efficiency, it drives cost reduction, it drives a lot of benefits to the industry.
I wanted to get back to the structured products because as a communications guy, my knowledge of finance is broad, not necessarily deep. And I hear you guys talking about accumulators and decumulators and
Sure.
accelerators, and so you can do some pretty sophisticated stuff with our products, right? If you wanted to on crypto,
Yeah.
which is really hard to do otherwise.
Yeah, because of all the Basel III and prudential requirements, people are moving away from doing this. Broker-dealers are moving away from doing this. And investors also, they look at crypto and think, oh, that's got to be a risk. Anyone who has crypto on the balance sheet will think, oh, that's got to be a risky balance sheet. And so what we're seeing is we're seeing demand from investors who want to get into traditional exotics, stuff that they've been trading and buying and investing in for years. The barrier reverse convertibles, the autocallables, the accumulators, the decumulators, traditional structured products that they've done in the equity space or FX space, for example, and they want to have a different asset class behind it because you get different types of yields and different kinds of payoff structures that could work here, or apply similar payoff structures to a different asset class. And we're seeing a lot of demand from that in Europe as well as in Asia for this.
Interesting. Any good examples you can talk about that we've done?
Yeah, I mean, we launched an accumulator with a company called EDG, which is based in both the US and the UK. Very, very smart guys, and they are a crypto derivatives broker. And so they're very good at pricing vol, right? So they manufacture the derivatives, and they are able to use our structures to wrap it into a security. So an off-balance sheet structure with an ISIN attached to the security. And people can invest in this now. And we're going to do a lot more. I mean, we're seeing more demand from other crypto derivative brokers who are coming to us and say, how do we do the same thing?
So Mark, we're based here in Switzerland,
Yep.
obviously, and Switzerland has long been a front runner in the crypto space and the blockchain space from the early days in Zug in the Crypto Valley.
Yep.
That grew up here, where I was quite heavily involved in 2016, 17, and 18.
Right.
And the market has really matured in an amazing way. So what are you seeing? I mean, when you look at the Swiss crypto ecosystem,
Right.
what are the things that stick out for you?
I mean, look, I'm new to this country, and so for me, I'm still learning. But what I've heard is that there are 34 banks in Switzerland that can custody digital assets. I would love to see what that actually means. But if that is actually true, then what we're seeing is there's demand for this kind of space in this country alone. And if they're able to do derivatives, then structured products for them becomes a no-brainer, right? They can offer that to their clients as well. And so you got a lot of crypto native banks who are actually coming to us and asking us if they can do that in an off-balance sheet fashion. And that's very cool.
And if you look ahead, let's talk about the future.
Let's
What
talk
are you
about it.
seeing, or what's your opinion of where this is all leading, of the merging of TradFi and DeFi?
Yeah.
And what's your sort of market and ecosystem outlook, let's say, for the next 3 to 5 years?
There is a tremendous amount of things happening, and that's driven by the US generally, right? Trump, love him or hate him, he's moving at a ferocious speed, and things are really changing in the US from the Genius Act to Stablecoin Act. We're going to see a lot of regulatory compliance coming out of the US, good or bad. But I think it's going to affect the industry in a positive way. We're going to see a lot more tokenization coming. They're going to be moving from cash to money market funds to private credit and private yield. We're going to see that happen right now. We're going to see maybe some acceptance of DeFi as well, because at the end of the day, DeFi essentially removes credit risk and replaces it with technology risk. And so I think people are getting more comfortable with that. We're not there yet, but we will get more comfortable with that.
But do you think really, and I almost feel like a heretic when I ask this question, but like I said, I've been in this space for a while.
Yeah.
And, I fell down the rabbit hole myself, and I really fell in love with the idea of decentralization and was very keen on seeing this technology bring it in. It's been a bit slow. And I've kind of learned over the years that I'm not 100% sure that the masses, myself maybe included, really want full decentralization, or if we're always going to need these intermediaries. You know what I'm saying?
I know what you're saying. I think people have gotten accustomed to, if they make a bad transaction using your bank or something happens, transactions can be reversed. Having a decentralized blockchain will not allow you to do that. And that becomes tricky. I think people want the decentralized nature of it until something bad happens to them.
Right, right.
And so I still think we're on that cusp. We're not there yet.
Okay. So that speaks for blockchain as really as a new type of, or an additional rail, additional infrastructure with some great advantages, but that's going to be fixing the system we have instead of replacing.
So we're seeing a shift from what's happening in TradFi to what's happening, or mimicking what's happening in TradFi to seeing what's happening in DeFi as well, from tradable yields to baskets to every kind of thing. So there are even structured products on chain, right? So we can see that with what Obligate is doing. We know them very well. And so is there a demand for this stuff natively on chain? We don't know yet. The market's still finding its feet.
Okay. Well, Mark, this was a fascinating conversation. Thanks for coming.
I hope it was.
Good to have you. Yeah. Cool, man.
Thank you.
Thanks.
Good to
Bye.
see you.